Silver didn't just fall, it was liquidated in less than 48 hours. The metal that speculators called the people's gold lost nearly everything it gained in weeks. But here's what nobody's saying out loud. Gold didn't follow. Instead, it's staring at $6,000 like a predator eyeing prey. The dollar index is sitting at a decision point that will determine whether fortunes are made or obliterated. In the next 72 hours, we'll separate those who read the signals from those who react to the headlines. What just happened in the metals market wasn't an accident. It was a message. Welcome to Currency Fictions. Now, before we go any further into what this liquidation actually means for your portfolio and your future, let me ask you something the way one would ask a seasoned veteran who's seen markets rise and fall for decades. Have you subscribed to this channel yet? Because if you've been watching our economic briefings, learning from our analysis, and benefiting from the strategic warnings we provide week after week, then it's time to make it official. One click, that's all it takes. Hit that subscribe button like you're locking in a position you know will pay off. And while you're at it, drop a comment below and tell us, where in the world are you watching this from right now? Are you in New York, London, Singapore, Dubai, Karachi? Because understanding where our audience sits geographically helps us understand who's watching the sunrise and who's watching empires crumble in real time. Now, let's get into what just happened. And more importantly, what happens next. The metals market does not collapse quietly. When silver falls, it falls with force. And on February 4th, 2026, that force arrived without warning. Within a span of 48 hours, silver prices dropped in a manner that veteran traders recognized immediately. This was not a correction. This was not profit-taking. This was liquidation, the kind that happens when leverage meets panic, and the market decides who survives and who gets wiped out. The price chart told a story that numbers alone could not capture. Silver had climbed steadily for weeks, building momentum as investors piled in, convinced that industrial demand and monetary instability would push prices higher. They were not wrong about the thesis. They were wrong about the timing. And in markets, timing is everything. When the sell-off began, it started with a crack. A support level that had held firm for days suddenly gave way. Within hours, algorithmic trading systems detected the break and executed pre-programmed sell orders. What began as a technical breakdown became a cascade. Margin calls went out. Traders who had borrowed heavily to amplify their positions were forced to sell, not because they wanted to, but because they had no choice. The volume data confirmed what price action suggested. This was not retail investors taking profits. This was institutional scale liquidation. Futures contracts were being dumped at a pace that overwhelmed buy-side demand. The physical market, where actual metal changes hands, remained relatively stable. But the paper market, where leverage dominates, was in free fall. Silver dropped through one support level after another. Each breakdown triggered stop-loss orders, which triggered more selling, which triggered more stop-losses. This is how liquidation events work. They feed on themselves. Fear creates selling. Selling creates more fear. And the cycle does not stop until every weak hand has been shaken out. Traders who had entered positions with confidence just days earlier found themselves staring at margin calls they could not meet. Some held on, hoping for a bounce. Others capitalized and accepted their losses. But the market did not care about hope or strategy. It only cared about one thing: who had liquidity and who did not. The derivatives market played a central role in accelerating the decline. Silver options that had been deeply in the money just a week earlier were now worthless. Exchange-traded funds that tracked silver prices saw massive outflows as investors rushed for the exits. The selling pressure from ETFs added fuel to an already raging fire. But here is where the story becomes more interesting. Gold did not follow silver down. In previous precious metals corrections, gold and silver moved together. When one fell, the other fell with it. But this time, something was different. While silver was being liquidated, gold held its ground. It did not surge higher, but it did not collapse either. It simply waited. This divergence was not random. It was a signal. Gold and silver are often discussed as if they are the same asset. They are not. Silver is industrial. It is used in solar panels, electronics, and medical equipment. Its price reflects both investment demand and real-world consumption. Gold, on the other hand, is pure monetary metal. Central banks hold it. Sovereign wealth funds allocate to it. It does not depend on industrial demand to justify its value. When silver fell and gold did not, the market was saying something clear. The problem was not with precious metals as a category. The problem was with leverage, positioning, and speculative excess in silver specifically. Analysts who had been tracking the gold-silver ratio noticed something unusual. The ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, spiked dramatically. Historically, when this ratio moves sharply higher, it signals that investors are fleeing from risk and seeking safety. And in the precious metals world, gold is safety. Meanwhile, central banks continued buying gold as if nothing had happened. Data from international reserve reports showed no slowdown in accumulation. Sovereign buyers were not reacting to short-term price swings. They were building positions based on long-term monetary strategy. This is the context that matters. Silver's collapse was real. The losses were real. The liquidation was brutal. But it was not a collapse of the precious metals thesis. It was a collapse of crowded positioning and excessive leverage in one specific market. The question now was not why silver fell. The question was, what comes next? Did this liquidation flush out the weak hands and create a foundation for the next rally? Or did it signal a deeper structural shift, one that would take months to resolve? And while silver traders were licking their wounds and reassessing their strategies, gold was quietly positioning itself for something bigger, something that would make silver's collapse look like a sideshow. Because gold was not falling, gold was aiming for $6,000. There's a moment in every market cycle when the crowd realizes they were watching the wrong asset. This was that moment. While headlines screamed about silver's collapse and traders frantically calculated their losses, something far more significant was unfolding in plain sight. Gold was not just surviving the chaos, it was thriving in it. And the divergence between these two metals was about to rewrite the narrative that most investors thought they understood. In the 72 hours following silver's liquidation, gold's behavior revealed something that technical charts alone could not explain. This was not merely a safe haven bid. This was strategic accumulation disguised as stability. The price was not exploding higher, which is exactly what made it dangerous. Quiet accumulation is always more powerful than loud speculation. Consider what was happening beneath the surface. While retail traders were fixated on silver's dramatic collapse, institutional players were methodically building gold positions at levels they considered strategic entries. The order flow data painted a picture that contradicted the mainstream narrative. Large block trades were being executed with precision. Someone with serious capital was using silver as chaos, as cover to position for gold, as next major move. The gold-silver ratio had spiked to levels not seen since the early days of the pandemic crisis in 2020. Historically, this ratio has served as one of the most reliable indicators of market stress and capital flight patterns. When the ratio rises sharply, it signals that investors are abandoning speculative positions in silver and seeking the ultimate monetary safety of gold. But here is where conventional analysis falls short. Most traders treat the gold-silver ratio as a mean reversion indicator. They assume that when the ratio gets too high, it will eventually come back down as silver recovers. What they fail to understand is that during periods of genuine monetary instability, the ratio does not revert. It expands, and it stays expanded until the underlying crisis resolves. Central banks were providing the clearest signal of all. Monthly reserve data from major economies showed uninterrupted gold accumulation. China's central bank had been adding to its gold reserves for 18 consecutive months. Poland, Singapore, and India were following similar patterns. These institutions were not reacting to price. They were reacting to something far more fundamental: the deteriorating confidence in fiat currency stability. This is where the $6,000 target enters the picture. On the surface, $6,000 per ounce sounds like a round number pulled from thin air. It sounds like the kind of target that analysts create for headlines. But the reality is far more technical and far more calculated. Multiple analytical frameworks were converging on this exact price level. The open interest in gold call options, with a $6,000 strike price, had increased dramatically over the past 6 weeks. This was not retail speculation. These were large, expensive positions being established by traders who had done the math and were willing to bet serious capital on a specific outcome. But options positioning alone does not move markets. What moves markets is the intersection of technical setup, fundamental catalyst, and positioning pressure. And all three were aligning. Gold had broken above its previous all-time highs weeks earlier and had been consolidating in a tight range ever since. This consolidation was not weakness, it was compression. The longer a market consolidates after a breakout, the more explosive the next move typically becomes, and the direction of that move is almost always in the direction of the breakout. Meanwhile, mining companies were providing their own forward-looking signal. Major gold producers had reduced their hedging activities to near zero levels. When mining companies hedge their production, it signals they believe prices have peaked. When they stop hedging, it signals they expect prices to continue rising. The collective behavior of the industry was clear. They were not selling their future production at current prices because they believed higher prices were coming. Physical gold markets were showing stress that paper markets were not reflecting. Premiums for physical gold bars and coins had widened significantly. Delivery delays from refineries were extending. Vault inventories in major trading hubs were declining. These are not the characteristics of a market that is about to correct. These are the characteristics of a market where demand is quietly overwhelming supply. The technical chart structure told its own story. Gold had formed what traders call an ascending triangle. A pattern where price makes higher lows while repeatedly testing the same resistance level. And that resistance level sat just below $6,000. Every time gold approached this level, it pulled back, but each pullback was shallower than the last, and each bounce was stronger. This is textbook accumulation behavior. Large players do not buy all at once. They accumulate gradually, allowing price to test resistance multiple times while they build their position. And when they have accumulated enough, they stop defending the resistance. They break through it. And when 6,000 breaks, the next question becomes how far beyond 6,000 gold will travel before finding its next equilibrium. The monetary backdrop made gold's trajectory even more compelling. Real interest rates, which measure the return on bonds after accounting for inflation, remain negative in most major economies. When real rates are negative, holding gold costs nothing in opportunity terms. There is no yield being sacrificed. And in an environment where currency debasement is accelerating, gold becomes not just an alternative, but the logical default. Silver's collapse had done something unexpected. It had removed the noise. For months, traders had been debating whether to buy gold or silver. Now the market had answered that question with brutal efficiency. The speculative excess had been in silver. The strategic value remained in gold. And while most investors were still processing what had happened to silver, institutional capital was positioning for what was about to happen to gold. 6,000 was not a ceiling, it was a doorway. Every market has a puppet master. In precious metals, that master is the dollar. And right now, the dollar was standing at a crossroads that would determine whether gold's march to 6,000 becomes a victory lap or a trap. Understanding this relationship is not optional for anyone holding positions in metals. It is survival knowledge. Because the dollar does not ask permission before it changes the game, it simply moves and everything else adjusts. Here is what most analysts miss when they discuss gold and silver. They treat these metals as independent assets with their own supply and demand dynamics. They discuss mine production, industrial consumption, and investment flows as if these factors operate in isolation. But they do not. Every single variable in the precious metals equation is filtered through one lens: the relative strength or weakness of the United States dollar. The dollar index had been behaving strangely in recent weeks. It had not collapsed as gold rallied, which confused traders who expected the typical inverse relationship. Nor had it surged as silver fell, which would have confirmed a classic risk-off rotation. Instead, the dollar had been grinding sideways in a narrow range, coiling like a spring under pressure. And that coiling action was more dangerous than either a clear breakout or breakdown would have been. Markets can handle direction. What they cannot handle is uncertainty. When the dollar sits at a major technical decision point, it creates a standoff across every asset class denominated in dollars. Equity markets hesitate, bond markets wait, commodity markets freeze, and precious metals, which have the most direct inverse relationship with dollar strength, become suspended between two opposing gravitational forces. The current technical setup on the dollar index chart revealed the magnitude of what was at stake. Support sat at a level that had held for months. Break below that support, and the dollar would confirm a structural downtrend that could last quarters or even years. Hold that support and rally, and the dollar could invalidate every bullish precious metals thesis built on currency debasement fears. This was not a minor swing trade setup, this was a macro pivot point. Treasury yields added another layer of complexity to the dollar equation. Yields on 10-year government bonds had been rising steadily, which typically strengthens the dollar by making dollar-denominated assets more attractive to international investors. But this time, yields were rising for the wrong reasons. They were not rising because the economy was strong. They were rising because bond buyers were demanding higher compensation for holding long-term debt in an environment of exploding deficits and monetary instability. This is the difference between healthy yield increases and distress signals. Healthy yields rise when growth accelerates. Distress yields rise when credibility erodes. And the current yield environment had all the characteristics of the latter. The carry trade dynamics were equally revealing. For years, investors had borrowed in low-yielding currencies like the Japanese yen to invest in higher-yielding dollar assets. This trade worked beautifully as long as the dollar remained stable or strengthened. But if the dollar weakened meaningfully, the entire structure would unwind. And unwinding carry trades create violent, self-reinforcing moves that dwarf ordinary market corrections. There were early signs that carry trade positions were being reduced. The yen had strengthened unexpectedly against the dollar in recent sessions. Swiss franc positioning showed similar patterns. These currencies act as canaries in the coal mine. When they strengthen despite no obvious fundamental catalyst, it usually means that large players are unwinding leveraged positions and returning to safety. Then there was the geopolitical dimension that most market participants were underestimating. The global movement away from dollar dominance was not a future threat anymore. It was a present reality playing out in slow motion. BRICS nations were settling an increasing percentage of trade in non-dollar currencies. Oil transactions were being invoiced in yuan, rupees, and even gold-backed instruments. Central banks were diversifying reserves away from dollar assets at a pace that would have been unthinkable a decade ago. The question was not whether de-dollarization was happening. The question was how fast it would accelerate and whether the dollar could maintain its premium despite these structural shifts. And this question was directly feeding into gold's behavior. Gold was rising not because the dollar was collapsing. Gold was rising because confidence in the dollar's eternal dominance was eroding, and that erosion was happening among the exact institutions that matter most: central banks, sovereign wealth funds, and multi-generational family offices that think in decades, not quarters. The Eurodollar system, which represents offshore dollar liquidity outside the United States banking system, was showing stress fractures that few were discussing publicly. Eurodollar rates had decoupled from onshore dollar rates in ways that historically preceded major liquidity events. When offshore dollar markets tighten while onshore markets remain liquid, it signals that international trust in dollar availability is weakening. This matters because the Eurodollar system is many times larger than the domestic dollar system. It is the plumbing through which global trade flows. And when that plumbing shows cracks, smart money does not wait for the flood. It moves to higher ground before the warnings become obvious. Emerging markets were providing their own real-time stress test of dollar dynamics. Countries with large dollar-denominated debt loads were facing refinancing pressures as interest rates remained elevated. Turkey, Argentina, Pakistan, and Egypt were all managing currency crises that stemmed directly from dollar strength and the inability to service dollar debts. Each crisis created another incremental reason for global institutions to question whether dollar dependence was sustainable. But here is the strategic irony that makes this moment so treacherous. A dollar crisis would initially strengthen the dollar, not weaken it. When global instability accelerates, capital flees to the perceived safest harbor. And despite all its structural problems, the dollar remains that harbor. This is why gold can rise alongside the dollar in certain environments. Both assets benefit from the same fear, the fear that the current monetary system is not as stable as it appears. The technical levels on the dollar chart that mattered most were now clearly defined. A break below 101 on the dollar index would confirm breakdown and likely trigger a sharp rally in gold. A rally above 107 would confirm bullish continuation and likely pressure gold back toward consolidation or correction. And the current price was sitting almost exactly in the middle of that range. Traders were watching. Central banks were watching. And algorithmic systems managing trillions in capital were watching. Because when the dollar makes its next decisive move, every other market will react within milliseconds. There will be no time to analyze, no time to reconsider positions, and no time to wonder whether the thesis was correct. The dollar was not just another indicator. It was the indicator, and its next move would either confirm that gold's path to 6,000 was clear, or reveal that the entire precious metals rally had been built on a foundation that was about to crack. The time for theory has passed. What remains now is execution. Silver has collapsed. Gold is staring at 6,000. The dollar is coiled at a decision point. And investors are left with a question that separates amateurs from professionals. What do I do next? Because markets do not reward those who understand what happened. Markets reward those who position correctly for what happens next. The first principle of strategic positioning is scenario planning. Markets do not move in straight lines, and neither should investment strategies. There are three primary scenarios unfolding from this point, and each requires a different response. Scenario 1 assumes that silver's collapse was a flush, a violent clean-out of weak hands and excessive leverage that clears the path for the next rally. In this scenario, silver finds a bottom within days, establishes support, and begins rebuilding. Gold continues its march towards 6,000 with minimal resistance. The dollar breaks down below its key support level, confirming the structural bear trend that precious metals bulls have been anticipating. This is the scenario where those who buy the fear get rewarded within weeks. The probability of this scenario depends entirely on what happens in the next 5 to 10 trading sessions. If silver stabilizes above its recent lows and gold holds its ground without giving back gains, the flush thesis remains valid. If central bank buying continues at current rates and physical demand stays elevated, the fundamental support for this scenario strengthens. But if silver continues grinding lower and gold starts showing cracks, this scenario loses credibility quickly. Scenario 2 is darker and more dangerous. In this version, silver's collapse was not a flush, but a warning. It was the first domino in a broader precious metals correction driven by unexpected dollar strength. In this scenario, the dollar breaks higher through resistance. Treasury yields surge, and capital rotates back into traditional financial assets. Gold does not reach 6,000. Instead, it corrects back toward 5,000 or lower. Silver continues its descent, potentially testing levels not seen in over a year. This is the scenario where holding positions without stop losses leads to significant capital destruction. The leading indicators for this scenario are clear. Watch the dollar index closely. If it breaks and holds above 107, this scenario becomes more probable. Watch gold's behavior at resistance. If it fails repeatedly to break through and starts forming lower highs, the technical structure is breaking down. Watch Treasury yields. If the 10-year yield pushes above recent highs and stays there, it signals that capital is flowing back into dollars and out of alternatives. Scenario 3 is the most complex, and perhaps the most likely. In this scenario, gold and silver continue to diverge dramatically. Gold reaches 6,000 and potentially moves beyond it, driven by central bank demand, monetary instability fears, and safe haven flows. But silver remains range-bound or weak, held down by industrial demand concerns and the lingering effects of its liquidation event. This scenario requires investors to think differently about precious metals. They are not a single asset class. They are two distinct markets that occasionally move together but are driven by fundamentally different forces. If this scenario unfolds, the strategic positioning becomes clear. Favor gold over silver. Except that the explosive gains many expected from silver may not materialize in the current cycle. Recognize that gold's monetary premium is reasserting itself in a way that leaves industrial metals behind. This is not a failure of the precious metals thesis. It is an evolution of it. Risk management must be addressed before discussing position sizing. No scenario analysis matters if an investor is over-leveraged and gets stopped out before their thesis has time to play out. The cardinal rule of positioning in volatile markets is simple. Size positions so that even the worst-case scenario does not eliminate the ability to participate in the best-case scenario. For those holding silver positions that are underwater, the decision tree is straightforward. If the position size is appropriate and the capital committed can withstand further downside without forcing liquidation, holding through the volatility may be justified if the investor still believes in the long-term thesis. But if the position is causing stress, sleepless nights, or represents capital that cannot afford further losses, reducing exposure is not weakness. It is discipline. Gold positioning requires a different calculus. Gold has not broken down. Its structure remains intact. The path to 6,000 is still visible on the chart. For investors who do not yet have gold exposure, the current environment offers a strategic entry point that may not exist once 6,000 breaks. For those already positioned, the question is whether to take partial profits at resistance or hold for the breakout. History suggests that taking some profit at major psychological levels is prudent, but leaving core positions in place allows participation if the breakout extends beyond expectations. Physical versus paper exposure is another critical consideration. Exchange-traded funds provide liquidity and ease of trading, but they do not provide the security of physical ownership. In an environment where trust in financial institutions is eroding and counterparty risk is rising, holding physical metal eliminates layers of systemic risk that paper products cannot avoid. The trade-off is liquidity. Physical gold cannot be sold with a click. It requires logistics, verification, and time. For serious allocators with significant capital, the strategy is not about timing the perfect entry or exit. It is about building a position over time that can withstand volatility while capturing the long-term trend. This means scaling in on weakness, scaling out on strength, and maintaining a core position regardless of short-term noise. The goal is not to maximize every trade. The goal is to still be positioned correctly when the major move happens. Mining equities add another dimension to precious metals exposure. Gold mining stocks provide leveraged exposure to gold price movements. When gold rises 10%, mining stocks often rise 20 or 30%. But this leverage cuts both ways. When gold corrects, mining stocks get obliterated. The current environment favors selective exposure to well-capitalized miners with low production costs and strong balance sheets. These companies can survive volatility and thrive in a rising gold price environment. Geographic considerations matter more now than they have in years. Where metal is stored, which jurisdiction it falls under, and how accessible it is during a crisis are questions that separate strategic positioning from naive accumulation. Holding gold in a bank vault in a country with capital controls is not the same as holding gold in a private vault in a jurisdiction with strong property rights. These details seem insignificant until they become the only details that matter. The forward timeline is condensed. The next 30 days will likely provide clarity on which scenario is unfolding. The dollar will either break its range or hold it. Gold will either push through 6,000 or reject at resistance. Silver will either stabilize and rebuild or continue its liquidation. These are not distant possibilities, they are immediate probabilities. For those watching from the sidelines, waiting for perfect clarity before acting, understand this. Markets do not provide clarity before they move. They provide clarity after the move is already in progress. By the time everyone agrees on the direction, the opportunity has passed. Strategic positioning requires acting on probabilities, not certainties. The metals market just delivered a brutal lesson about leverage, timing, and the difference between being right about a thesis and surviving long enough to profit from it. Silver's collapse reminded everyone that markets can remain irrational longer than traders can remain solvent. Gold's resilience reminded everyone that not all precious metals are created equal. What happens next will not be determined by hope, prediction, or wishful thinking. It will be determined by the dollar's next move, gold's ability to break resistance, and whether investors have positioned themselves to survive volatility while capturing opportunity. The market has spoken. Now it is time to listen.